and welcome to today's webinar. Over the next hour, we'll be walking through Nigeria's new tax laws, and we'll be exploring how they affect our investment strategies, right? Whether you're managing an portfolio, whether you're running a business, if you're a tech bro, I believe this applies to you because tax applies to everybody in the country. And so it is what getting the tax rules right and applying them to your daily commercial transactions as well as your investment decisions. Today, we have a highly skilled specialist who will be speaking to us on this topic and ensure that you are familiar with Nigerian tax rules. And but before I go into introducing our guest for today, I would like to just introduce the organizers of the webinar. And I'm sure you can see on the screen, the organizers of the webinar is One44k INvestors Community. The community will set up a vision, and the vision is to ensure that every member of the community understands and benefits from the investment over the long term. And our mission as well is to equip every member of the community with the required knowledge and skills through a variety of media and tools to help succeed in the long term. So we have a community, a WhatsApp group, which we'll share in the course of the presentation for you to join. We occasionally help our members be familiar with investment terms across different asset classes. Is it equity, debt, fixed income, crypto, name it. We have provision for all of that. And we are very confident that once you join the community, you'll take your investment game from 0 to 100 in a short while. So going straight ahead to why we're here, as I mentioned earlier, the theme of today's webinar is Introduction to Nigerian Tax, and it is aimed at ensuring you have foundational knowledge, what you should know as an individual and what your business should know, right, if you're a business owner. I mean, this webinar is aimed at every single person in Nigeria, whatever class you are in, it is for you, right? And as I mentioned earlier as well, we have a specialist and an expert who will be walking us through Nigeria's tax rules today, and I am very, very confident that you are going to be going with one or two things that you can use for your daily operations, for your commercial transactions, right? So going straight into the presentation now, I'd like to introduce our facilitator for the day. Our facilitator, her name is Mrs. Mayowa Olusegun, and she's a senior associate and team lead in tax practice of Olani Ajayi LP, where she brings over a decade of experience in providing comprehensive tax advisory. Her expertise spans corporate restructuring, tax planning, transfer pricing, and tax due diligence. She also brings extensive experience in managing tax audits and investigations at both federal and state levels, supporting corporate clients across diverse sectors in navigating regulatory reviews and meeting compliance obligations. So as you can see how our facilitator is well suited for the job. I encourage you to take out your notepads, take out your note apps, and ensure you jot as our facilitator takes us through the topic. So with that, I would hand over to Mrs. Mayowa Olusegun to take us further. Thank you very much, everyone.
Thank you very much for the introduction, Joel. It's a pleasure to be here. And thank you so much for the opportunity to share my knowledge with the whole house. Okay, before I proceed, I'd like to thank my team members at Olani Ajayi for helping put this presentation together. Thank you so much for coming in when it was necessary. Thank you, Stanley, particularly. So just to put a little bit of perspective on this, this presentation is, please confirm you can hear me, maybe with an emoji or something like that. So I'll be sure that I'm in here. All right, thank you. So thank you very much. So this class is very foundational. I strongly believe that before we can even talk about different tax aids, and particularly the ongoing discourse around the Nigerian tax reform, it is best to understand what Nigerian tax system or how taxes apply in Nigeria. And then from there, we can now take a snippet into what the new regime be like. Particularly, I'll also mention that I'll be going, okay, can you please go to the next slide? The content of the presentation, I just want us to, the outline rather, to run us through the outline of the presentation. Yeah. So we'll be looking at the definition of terms, the introduction, which will be quite broad. And from there, we'll look at the overview of the Tax Reform Act and all the taxes here in Nigeria, then taxation of individuals, taxation of companies. We'll look at the notable changes, penalties before we proceed to the conclusions. The next slide, please. So the definition, there'll be some, because some of these tax laws are quite long to pronounce, so I'll be using them in acronyms. NTA stands for Nigerian Tax Act, which we'll be dwelling in a lot in the course of the presentation. The Nigerian Tax Administration Act, and a couple, as you can see on the screen, they are just acronyms to help us understand. And particularly when I say the Tax Reform Act, I'm talking about all the four acts: the NTA, the NTAA, the NRSA, and the JRBNEA, which was recently enacted on the 26th of July this year. So these are the key words. So probably when we follow in the presentation, you understand what I'm referring to when I'm saying, for example, relevant tax authority. It could be the Federal Inland Revenue Service, which will soon be named the Nigerian Revenue Service, and the State Inland Revenue Services of the respective states within Nigeria. The next slide, please. So we know President Bola Ahmed Tinubu set up the Presidential Committee for Fiscal Policy and Tax Reform sometime, I think 2023, after he became president. One key objective of that committee was to reform the Nigerian tax landscape. And to just give perspective, we know, and probably we've heard in the news, that Nigeria has been always have to resort to borrowings to fund its spending. So we always have a recurring budget deficit in the country. So the objective of regimes, particularly for this current regime, is to ensure that the internally generated revenue from taxes is increased, particularly to ensure that the tax to GDP ratio is increased to 18% in the next couple of years, I think 2026 precisely. So the committee got to work, and there were a lot of sensitization programs. Of course, the committee was not made of one or two persons. They were drawn across different walks of life. We have people from the academia, we had persons from the tax professionals, we had business representative of business interests, like chambers of commerce, we had tax professionals, we had lawyers, we had, like I mentioned, academia, all to ensure that all interests were fully represented. And of course, the relevant tax authority, the custom, they were all represented. And at the end of the day, 4 bills were transmitted to the president. And in a landmark event, the 4 acts were signed on the 26th of June this year. And we now have an imminent tax regime, which it will fully be implemented on the 1st of January 2006. Now, this tax regime, I believe we have heard at one time or the other some of the changes that have been introduced. We know that the Nigerian Federal Inland Revenue Service will soon be known as Nigerian Revenue Service. It's going to foster a centralized tax administration. We are going to have consolidated, or we now have consolidated tax law. So instead of having to look around different pieces of legislation, we have a single legislation that cuts across the imposition of tax across different heads. And of course, the whole aim is to ensure that we have an expanded tax base and many other changes. Of course, these changes are going to impact everybody, including me, myself speaking, and particularly for businesses, because tax has to do with payment of money. And of course, there have been a lot of generation of traction in this news. Everybody has been interested. And so this is why we are here. Let us even unpack, let us understand Nigerian tax. What is it about? How does it concern me? For some of us, we just see that some particular deductions are made from our salaries, and some for business, so that once in a while you get letters from the tax authorities. Some you can make sense of, some we don't know what it's all about. So that's what we want to do. We want to try to understand how the Nigerian tax framework works and what this new regime stands to bring to bear in the coming days. Please, the next slide. So there are a couple of quotes I've introduced in this presentation. There are 2 things. It was said by Benjamin Franklin that in this world, nothing can be said to be certain except debt and taxes. The other thing here is that tax avoidance is a natural thing. It is like gravity. And the reason, this 3rd quote tells us why. The reason why anybody, even though we know taxes are certain, and we know that nobody wants to really pay tax. So if tax were to be voluntary, the default position would be to avoid it. But the only reason we can't avoid it is because of its of the legal implication, because it is statutorily based. And so it will really be nice to pay taxes without letting go of cash, but normally cash will be required. So those are the quotes. So what does that tell us? It simply tells us that taxes are here to stay. It is best to know and not be ignorant so that they can be properly managed, particularly because default in meeting tax obligations carry a lot of implications as individuals and particularly for business. There are penalties, simply penalties that come with interest, and I will see that somewhere down in the presentation. The next slide, please. So we are trying to unravel what exactly is tax. We just hear tax this, tax it. What is? So what is tax? Tax in and of itself is any compulsory payment to government. It is imposed by law, and it doesn't necessarily have to have any direct benefit or return of value or service. It can be called tax, or it may not be called tax. But as long as it is compulsorily imposed on residents of a jurisdiction, whether you get any direct benefit or not, it is a tax. Now, this other definition is tax is a pecuniary burden laid upon individuals or property to support government and is a payment exacted by legislative authority. It's similar to the first one. We see that it is compulsory. It is a compulsory exaction, meaning that it's a compulsory payment that must be made because the law says so. And it is only imposed by law by the governing body of a jurisdiction, whether it's Nigeria, outside Nigeria. Tax is a universal language. but the administration of it differs across different jurisdictions. Then the third definition is a monetary charge imposed by government on persons, entities, or properties, and it's essential levy to yield public revenue. I had mentioned earlier that the reason government in and of itself does not do business, most of the time, it doesn't carry out economic activities. So in order to drive its constitutional obligations to protect property and citizens, to provide education, all that we expect government to do, their money must be expended. And the only way government can fund those activities is by imposing taxes. So that is why we have to pay tax. I'm not standing here to speak for the government, but that is just in a nutshell what taxes and why taxes have to be paid. And that is why Benjamin Franklin said that it is as certain as death. Please, let's go to the next slide. Now, I've tried to also look at it. Currently, there are several pieces of legislation speaking to tax obligations, but I just picked two from the Constitution. And it says there that it shall be the duty of every citizen to declare his income honestly to appropriate and lawful agencies. So it's not anybody that comes that should ask for to be paid tax. It is only to appropriate and lawful agencies. And that was why there are cases decided by the court that when there's no legal basis for it, or the wrongful agency is making the demand for taxes, you can defend a position based on the law to say that, no, I'm not supposed to pay tax, because taxes are to be paid to appropriate and lawful agencies. And the obligation is also on every citizen to pay the tax promptly. And may I also add, without demand or notice by the appropriate or lawful agency. Then Section 44A of the Constitution, which speaks to the right to hold property and to prevent compulsory acquisition of property, whether intangible or tangible property. It says, even though there's that right to own property, it does not preclude government from imposing or enforcement of any tax rate or duty. So cash or monies that we pay in taxes are property, but the law, even though the Constitution protects the right to own that property, it also says that, hey, government can come to ask for its due to carry out its obligations. So this is to say that the Constitution imposes the obligation on every citizen to pay tax, even though you own property. Government has, in a sense, the right to make a demand for everyone to pay tax. So we go to the next slide. So I've spoken earlier about the work of the Presidential Committee on Fiscal Policy and Tax Reform, and this is a slide snippet from one of their presentations. So on this slide, they were trying to explain what the current situation here in Nigeria is, particularly with respect to the duplicity or multiplicity of taxes. Now, as I had earlier mentioned, also Nigeria operates a federal system of government, meaning that they are federating unit that is centrally administered or that is independent, and at the same time having a federal body, which is the federal government as we know it, that also supersedes. So for each of these tiers of government, we have the federal, the state, and the local. They all have taxes and levies that are imposed on citizens. So you can see on the side of the federal government, we have the company income tax, withholding tax. We'll speak more in details to some of these tax heads. We have the preferred profit tax. So for the federal government alone, you can see 1 to 17. For state, you can see 1 to 25. For the local government, we can see 1 to 21. So that has been the challenge, multiplicity of tax, which is one of the major things that the reform seeks to do, to help us understand or maybe consolidate these taxes, make them simpler to understand, and maybe tougher to evade, as the case may be. But this is where we are. Each tier of government imposes tax. And in the next slide, we'll be talking about some of these key taxes, not necessarily everything. We'll just talk about a couple of them. Please, you can move on to the next slide. So we are looking at the overview of key tax legislation, and we're talking about key ones. Now, on the with respect to the existing regime, these tax laws, I think about 12 of them here, they are the ones that have been repealed as a consequence of the Tax Reform Act. So in the Nigerian Tax Act, the NTA specifically, all of these ones to my left have been repealed, but meaning that from the 1st of January 2026, they will no longer be in existence. And then the one to my right, that is under the incoming regime, we have 4 acts. So a couple of them, the provisions in each of the PITA, the CITA, the PPTA, the VAT Act, the CGT Act, stamp duties, etc., have been merged and consolidated under the NTA, the Nigerian Tax Act. Now, the the administering bodies, meaning the state and the federal tax authorities, currently the State Internal Revenue Service and the Federal Revenue Service, the system of administering the taxes, meaning when should you pay these taxes? Who should you pay them to? When should you file those tax returns? They are coming, and the penalties for non-compliance, they are broadly seen or contained in the Nigerian Tax Administration Act. Now, the Nigerian NRS speaks to is the replacement for the current FIRS, which is imbued with more powers to cover all revenue accruing to the government compared to what we currently have today, as well as the Joint Revenue Board of Nigeria Establishment Act. We'll speak more to each of these taxes in subsequent slides. You can move on to the next slide. Now, we'll now start talking about each of these taxes. So what is VAT? So VAT is a consumption-based tax that is levied on the supply of goods and services, and the tax rate is 7.5%. So it is consumption-based. Okay, before I go on, I would like to add that the way these slides, so 1 to VAT, custom duties, excise duty, and stamp duties, they are essentially direct tax, while the remaining ones that we'll be speaking to are indirect tax. Sorry, it's the other way around. They are essentially indirect tax, while the other ones are direct tax. And what does that mean? Indirect tax are the taxes that, even though are paid by certain persons, they do not ultimately bear the burden. So, for example, I'll just use the example of cars. When cars are imported into Nigeria, custom duties are paid, and it is the importer that bears the burden. But upon selling to the final person that buys the car within Nigeria, the selling price, we include the custom duties that have been paid. So the person that pays for indirect tax only pays at the point to ensure that is able to transfer the burden of the tax to the ultimate consumer of the good and service. So that is why it is indirect. Ultimately, it is the person that is enjoying or consuming that good or the service that will actually bear the burden. And that's why, using cars, for instance, when the prices or the import duty, custom duties rise, we see that the prices of cars fluctuate accordingly, because the cost of the duties or custom duties are passed on to the ultimate consumer. I hope that clarifies. So that is what indirect taxes are really about. It is ultimately borne by the person that enjoys the service or the goods. Now back to value-added tax. So it means that the more goods and services are consumed, then the more VAT are paid. So whoever is selling those goods and services, apart from the cost of the goods, say you pay for a professional service, you are charged ₦1 million, VAT is charged at 7.5% of the 1 million naira. So you'll be liable to pay ₦1,075,000 for that service. And it is the ultimate consumer that will bear it. Now in Nigeria, under VAT, we have it's still the same thing, but it's kind of for ease of understanding, I'll say there's input VAT and output VAT. Currently, which I will still speak to in subsequent slides, input VAT, to claim input VAT, VAT in, can I say, manufacturing is limited to, input VAT claim is limited to goods produced by manufacturers and merchandising, meaning that in the chain of manufacturing, maybe you've purchased raw materials, you've paid VAT, you are able to recoup it back from the FIRS once you are filing your VAT returns. And apart from those two categories or broad categories, every other person that pays VAT, we have to expense it, meaning that once you pay for that professional service I earlier mentioned, it will have to be borne by the person that paid it. I think I'll go into better details as in subsequent time, but all of that is about to change. So when you get to pay for a service and you see VAT at 7.5, that is what it's about. If you don't consume anything, you won't be liable to VAT. But as long as you consume, you will definitely pay VAT. Then we move on to custom duties. I think I've explained that when I was speaking earlier, and it speaks to importation of goods within the territory of Nigeria, cross-border transaction. It is currently being levied by the custom authority, Nigeria Customs Service, but from next year it will come under the Tax Reform Act has made provision for it to be administered by the Nigerian Revenue Service, because it has an expanded scope of services it will be undertaken. Then it ranges between 5 to 35%, depending on what you are consuming or producing, importing into Nigeria. Then we move on to excise duties. Unlike custom duties that is with respect to cross-border transactions, excise duties on specific goods that are produced within Nigeria, such as alcohol, tobacco, carbonated drinks. It's still administered by the customs service, and it's also ad valorem basis of fixture. What does that mean? It simply means that it is the cost, or maybe the price of that unit, maybe it's 1% of the price. So the more the price of the let's say carbonated drink, if it's at 1%, it will be 1% of say 5 naira. If it increases to 15 naira, so it is 1% of 15 naira. So it's not kind of fixed. It is the price of the good that is being charged to excise duties that will determine the ultimate amount the person liable to pay. Then there's also the fixed charge, meaning that irrespective of the price, you ultimately pay the same amount. And this explanation is also relevant for SD, which is stamp duties, because it's also at both ad valorem or fixed fee. And what do stamp duties apply to? So stamp duties is an old tax legislation, pre-independence legislation, and now the good thing now, it has been simplified in the new tax regime, and it's levied on documents, instruments. We call it chargeable instruments. So when you convey interest in land, you buy a landed property, you are required to stamp your transaction documents. If it's between individuals, meaning the contracting parties are individual, you have to stamp it with the state tax authority. If it involves a company, the stamp duties have to be remitted to the federal or the federal tax authority, as the case may be. Transaction documents such as I just mentioned conveyance of interest in land. Okay, one very obvious example is the electronic money transfer levy. So for transactions above 10,000 and above, you are charged a flat fee of 50 naira, so which you see deducted from your bank account. It is provided for under the Stamp Duties Act. So, and quite a number, and contract notes, when you, for those that trade in stocks, so such transactions are liable to stamp duties. So move on to the next one, which I believe applies to everybody on this call, which is personal income tax. It is paid on income and profits earned by individuals. Income for your salary, your side gigs, your business, some people call it side hustle. The profit you make from that, it is liable to tax, and it's payable to the State Internal Revenue Service. The rate currently is at 7 to 24%. Then we have company income tax, which is represented as CIT. It is paid on profits of companies that they have accrued, derived from, brought into, or received in Nigeria, and they are not liable to tax under other pieces of legislation. Now, currently, for companies are broadly categorized into two. We have the small companies, we have the medium companies, and we have the large companies. Small companies are companies that have revenue, meaning the income they've earned on their transactions. Say you are a pure water seller, you earn or you make 24 million in a year, you'll be categorized as a small company. Or you are an IT bro or company and you make profit of say 50 million, you'll be categorized as a medium company, because medium companies ranges from above 25 million to less than 100 million. Then you're a large company when you exceed the 100 million threshold, and you'll be liable to tax at 30%. Medium companies are 20%, and small companies are outright exempt from paying CIT. And may I also add here critically that even though exemptions apply, the obligation to file tax returns still stands. And the FIRS takes a very strong position on that, so that there is the risk of losing the exemption if you fail your tax return, so that the exemption is completely wiped off, and the such business, even using the example of the pure water company that earns less than 24 million, they stand the risk of paying tax at 20% for default. So move on to the next slide, please. Then we have the Petroleum Profit Tax and Hydrocarbon Tax. Just to give a background, the Petroleum Profit Tax Act has been in existence for quite some time. But in 2021, we had the Petroleum Industry Act, and it's to guide the fiscal obligations, as in tax obligations of companies, essentially in the upstream petroleum sector. So for such companies under the PPTA, they are taxed at 50 to 85%, depending on the kind of operations they have, whether it's onshore, deep onshore, depending. So they will their license regime. So it fluctuates between the 50 to 85%. And for hydrocarbon tax, which for companies that they have converted or are under the provisions of the PIA, it fluctuates between 15 to 30%. But in addition to hydrocarbon tax, they also have to pay CIT at 30%, meaning that for those uncut by the PIA, their tax rate will be fluctuating between 45 to 60%, as against the 50 to 85% for those under the PPT. We go back to the next one, to education tax. Now, education tax is at 3% of the assessable profits of Nigerian company, meaning that if you are not a Nigerian company, you will not be liable to education tax. So just to note that not being a Nigerian company does not mean that such entity will not be liable to company income tax here in Nigeria. Non-resident tax companies, as long as they fulfill they come within the criteria to be liable to tax, such as they derive profits from Nigeria, or they have a taxable presence or significant economic presence in Nigeria, they'll be liable to tax in Nigeria. However, they will not be liable to education tax because they are not a Nigerian company. Now, I also need to mention that apart from all these taxes that are here, there are a couple. I just decided to emphasize the key tax legislations. So for companies too, they also have ancillary levies they pay, like the police trust fund, which is a 0.005% of their profits, net profits. We also have the NASENI, the Nigerian Information Technology Development Levy, which is at 1% of their profit before tax, and all of that. A couple of other tax operations, but they are not highlighted here because I'm concentrating on the key ones. So the last one here is the capital gains tax, which is charged on gain derived from disposal of assets. So it is critical to note that where there's no disposal of assets, there won't be CGT. But once there's a disposal of assets, you now have to start coming within the boundaries of CGT. And we have examples for shares, land, compensation for loss of digital assets, and all of that. Now, for shares, the tax prior to 2021, shares were not liable, disposal of shares were not liable to CGT, but from 2021, disposals of shares is now liable to CGT as long as it does not cross, and this disposal proceed does not exceed is it 100 million, I believe, and it's even possible to avoid paying CGT when certain things occur, such as all the proceeds of the disposal are invested in another Nigerian company within the same tax year. So that is all on the existing key tax legislation, so that when we are speaking on the changes, we're able to have a foundational understanding as how it impacts. We can go on to the next slide, please. Now, the tax reform, I had said that from 1st of January 2026, we have the NTA, the NTAA, NRZAA, and the JRBNA fully operational. So we just speak a bit as to what they do. Now, though some of these I've earlier explained, the NTA specifically unifies all tax legislation, so you don't have it scattered. Because at the time when you start saying stamp duty, you have to go to another tax legislation. When you're talking Peter, income tax for individuals, another tax legislation. When you're talking CITA or CIT, you are looking at another tax legislation. But everything in the NTA, you have it consolidated with different chapters speaking to each tax head. So it is not to say that those taxes are no longer in existence, but it's just simply to say they have been consolidated in a single piece of legislation. So they are still in existence, and the separate pieces of legislation will now be repealed, and as well as over 14 other pieces of legislation were also amended, specifically bringing the fiscal framework in those pieces of legislation into the NTA. For example, provisions around taxation of upstream petroleum industry companies in PIA has been brought into the NTA, and a lot of other provisions as that as well. Then the NTA too is to provide uniformity in tax administration framework. So penalty regimes used to also be spread across these separate tax legislations. We have it also in the Federal Inland Revenue Service Establishment Act. But once you go to the NTA today, you want to know, okay, who should I file my PIT returns to? Okay, how do I know I'm resident in country A, in state A? It is there. And you know, it gives clarity and uniformity as well. Then the Nigerian Revenue Service Establishment Act is what repeals or now establishes what we are going to know very soon to be the Nigerian Revenue Service. So it goes beyond just collection of taxes. It also includes all federal revenues under its ambit. And I'll use another example. I've mentioned the customs. We are going to see a regime where the NRS will be responsible for collection of royalties paid by mining companies and oil and gas companies. It will now be paid to the Nigerian Revenue Service, and FIRS is working assiduously to ensure that this transition is fully seamless and pain-free for all taxpayers. And I attended a meeting, was it yesterday or recently, where they were trying to help taxpayers understand, or affected persons understand, how mining royalties will be paid or going forward to the Nigerian Revenue Service. So work is really going on in full stream to ensure this transition process is fully done. Then we have the last one, the Joint Revenue Board of Nigeria Establishment Act. It gives the legal forum for revenue administration. So we have 36 states in Nigeria, and each of them have their own separate state internal revenue service. So in the process of administering, say, PIT, there could be issues. Oh, this person is resident in Lagos. No, he's in Ogun State. No, this person is resident in Abuja. No, he's in Nasarawa. Oh, this person is practically living on the high sea. No, he's in Bayelsa. So all those issues is under the purview of the joint revenue. It harmonizes revenue administration, brings them together, dispute resolution, also for taxpayers. Let me go into that. The tax appeal tribunal, that is also the powers, the jurisdiction, everything about the tax appeal tribunal is codified here. And what is the tax appeal tribunal? It is the administrative court for resolving tax disputes. So where you have issues around an assessment that's been raised about the tax authority, and it's not maybe interpretation of tax laws, and you feel very strongly that your position is not being resolved, even after exploring all the reconciliation mechanism within the tax authority, you can approach the tax appeal tribunal to resolve it. And then critically, the JRBNEA established what we now know as a tax ombudsman, which is like, can I say, gatekeeper between the taxpayer and the taxman, essentially ensuring the administrative issues around imposition of tax, policy administration are resolved without necessarily going to courts. But issues around tax dispute, meaning that whether an assessment is correct, overstated, should be reduced, should be expunged, the tax ombudsman does not have such powers. And it doesn't do the normal legal dispute mechanism where you have to lead evidence or whatever. It does not do that. It's administrative. It looks for alternative dispute mechanisms, so that conciliation, mediation, to resolve the past. And in the instance where the tax ombudsman is not, his position as communicated to the taxman is not being honored, the tax ombuds office can approach, I think, the state assembly to make a position. So those are the provisions under the JRBNEA, and is essentially to establish a dispute resolution structure and protect the rights of the taxpayer. And essentially, the tax ombudsman is like the face of the taxpayer, standing between the taxpayer and the tax authorities. Please, you can go on to the next slide. Now, we'll just give a very general overview of the major changes under the NTA, having looked at the current regime. As said earlier, that tax CGTs are 10%, company income tax or person is at 30%. Then for individuals, it's at between 7 to 24%. But in this case, under the NTA, we realize that the capital gains derived by a company or an individual will now be treated as one. What does that mean? Companies or individuals that have chargeable gains will no longer be paying tax at 10%. But what will happen is that both their profits that is ordinarily liable to CIT or PIT and their chargeable gains that used to be liable to CGT at 10% will be brought together. And if they're a small company, they will be exempt. If in the instance that they're a large company, they'll be liable to tax at 30%. For individuals, if their tax rate is at the rate is changing, it's now going to be between 0 to 25%, which we see in subsequent slides. If your tax rate is say a 21%, that means your CGT rate, your gains, chargeable gains, will be liable to tax at the 24%. I will explain that further in subsequent slides. I would like to see my slide. Okay, let me just go on. Another notable change we'll see there is on development levy. Now, for development, I mentioned that apart from CIT that companies pay, we also used to have education tax. We used to have because it's still operational, we have police trust levy, we have the NASENI levy, yes, we have the NIDA levy. All of that will no longer apply, but rather what will now be the case will be a development levy of 4% of accessible profits of companies. Another change there is about expense deductibility rules, meaning that taxes on profits, particularly for businesses, whether you're unincorporated or you're a company, meaning that it is your profit, essentially meaning your income less your expenses. It is what will be liable, will form your profit, and it is the profits that will be liable to tax. That's very simplistic, because when you are dealing with determining the profits of a company, is not necessarily the accounting expenses, all the accounting expenses that will be liable for tax purposes. But nonetheless, the rule for deductibility of expenses, business expenses, is broadly called the REN rule, meaning expenses that are wholly, reasonably, exclusively, and necessarily incurred for the business. So if you can bring your business expense under those broad categories, even though they are not been explicitly outlined, I think in section 22 of CETA, then you can claim a deduction for that expense. However, things are changing, and in the coming days, the rule has been, can I say, modified. So it is only expenses that have been wholly and exclusively incurred for the purpose of the business that will be allowable for tax purpose, removing subjectivity and making it more objective. So that's the way it's going to be going forward. Okay, then let me go back to the other one, which is introduction of rent relief. So for business individuals, in determining the chargeable income of an individual, which we will see in subsequent slides, we have what we call consolidated rent and relief allowance. We used to be 20%, sorry, 20% of the gross income of the individual, in addition to 200,000 or not more than 1% of the gross income, in simplistic way. But that has been changed, meaning and replaced with what we called rent relief, which is 20% of the rent paid, emphasis on paid, by the individual, and capped at 500,000 naira. So in practical terms, if you are, meaning that you cannot, to get the maximum amount of rent relief of 500,000 naira, you must be living in an accommodation that's, you pay an annual rent of 2.5 million every year. Otherwise, if you are living in areas where you are paying, say, 1 million per annum, you'll be liable to only claim, say, 200,000 as your deductible rent relief. By implication, it is very likely that the amount of relief under this head will be lower in the coming days. And issues around documentation, because you have to prove that you paid the rent, will become very important in the coming days. Now, the fourth one I'll be speaking to will be input VAT claim. Oh, I need to mention that this rule, this tax laws, a lot of clarifications, guidelines, circulars are expected, regulations are expected from the relevant tax authority, both at the state and federal levels, in the coming days, to give clarity on some things that are not, or what we call gray areas, in the coming days. For example, there will be issues. Let me just speak a little on the rent relief, because I know that it will be material to those of us on the call. If there are two people staying together in an accommodation and they both contribute to make the payment, how will the taxman deal with that? Because each person must show that he paid. And in instances where you contribute, maybe you transfer to Mr. A and Mr. B are living together, and Mr. A transfers to the account of Mr. B, and Mr. B is the person that pays to the landlord. How will Mr. A be able to claim his own portion of the rent paid for tax purposes? So a lot of things are still gray, which we believe will be clarified by the taxman in the coming way. But this is really a potential issue for disagreement in implementation next year. Now, I mentioned earlier, while speaking about VAT, on input VAT and output VAT, just to give a foundation. And I mentioned that generally under Section 17 of the VAT Act, we can broadly say that is merchandising companies or trading companies and manufacturing companies that are able to offset the input VAT they had paid in the course of their productive activities. But now the door has been flung open to almost everybody. I use that word very carefully, because without being technical, there are different, I don't want to say different, VAT cannot be charged on exempt items, and what we have also zero rated items. So care has to be applied in determining what you can actually claim input VAT on. But speaking generally, we can say that input VAT can be claimed on almost everything now, meaning that as long as you have suffered VAT, you can claim VAT, meaning that using my earlier example where you are paid for a professional service, in filing, let's say organization A paid VAT to a tax consultant, and in filing his VAT, meaning that he had made a sales of 2 million naira that month, which is the VAT due on that 2 million naira, I think is about 150,000 naira, and he has paid the tax consultant, say, a 1 million naira. So he has suffered tax VAT of 75,000, and he's supposed to pay the government 150,000. In filing the returns, instead of what he would have done today to pay the 150,000 naira and bear the brunt of the 75,000 naira on the tax services rendered by the tax consultant, what he can do, what he will do from 1st of January, because the law is very clear, you can't do it in December. It has to be from the effective date of the law, is to deduct the VAT he has suffered, which is 75,000 naira, from the 115,000 naira, ultimately paid only 75,000 naira to the NRS. If it were to be this year, he would have had to pay the entire 150,000 naira, and the 75,000 naira would have borne it, and like we say technically, he would have expensed it, and it would have impacted on his profitability. But in coming days, he will rather pay 75,000 naira, and it will show on his return, oh, I suffered VAT of 75,000, I'm to pay you 150. This is the difference, and we find the difference. And in instances where he has an excess, maybe he has suffered 150 and is only supposed to pay 75, so he has a 75,000 naira to claim from the government, he can claim an input VAT refund. The law is clear now. There won't be any need for an audit process. However, you must be very sure. You must be very sure that you are sure that you are sure that you actually can make that valid claim. And if you do, you can make the claim within 12 months and it will be refunded. The law is very clear, which was not available under, or which is not available under this current regime. I had spoken to the last point, which is on with definition of small companies. There will no longer be what we call medium companies. So the rate of 20% is no longer there, it's deleted. So we only have small companies that will be taxed at 0%, and large companies that will be taxed at 30%. Now, I had also spoken to definition of companies to be companies that earn turnover of 25 million or less, 25 and below. Now, small companies is now 50 million, and their capital asset not exceeding 250 million, and it particularly excludes businesses undertaking professional services that require technical expertise, knowledge, and is not vocational or in nature. So if you are a professional properly so-called, such as lawyers, etc., they won't come under that. But consulting companies, they won't be able to come under the definition of small companies, even though their turnover is less than 50 million naira. You can go on to the next slide. So I think we'll be looking at individuals now, and I think we'll be looking at it more in depth because I think it is very germane. So we'll delve more on individuals rather than companies here. So for all our individuals tax, the profits, under the new regime now, I need to mention that it's under this new regime. So taxation of individuals speaks to the income, the gains, the profits. The profit means that you are undertaking business activities. Income such as just employment income, income from investing activities, gains from disposal of chargeable assets. They are taxable in Nigeria on one condition: if you are resident in Nigeria. So if you are resident, whether you earn the money from the US, from South Africa, from Australia, no matter how far away the income you are earning is coming from, if you are resident in Nigeria, you are liable to be taxed on that income. Whether you are keeping it in your offshore account does not matter. A resident individual in Nigeria is liable to tax on his global income. Now begs the question that who is now a resident in Nigeria? So I'll know whether I am impacted or not. Under the previous regime, used to be residency was very clear, or was more streamlined. I think just one, meaning that you have a permanent place available for your domestic use in Nigeria on a particular day and does not consider a temporary lodging. So if you're in a hotel temporarily, say on the 1st of January, no, it must be available for your domestic. You sleep there, you sleep, you go there. It's domestic in nature, not makeshift. But now it has been expanded to be 3. Domiciled in Nigeria, it still retains a permanent place available for domestic use, and you're serving as a diplomat or diplomatic agent of Nigeria in another country. Now, the question is, what is domiciled in Nigeria? The law is silent. So these are part of the areas that we believe will be clarified in the coming days. But we can just take a sneak. I think the Nigerian, the position really is that domicile means a place that an individual intends to live indefinitely. Whether the person is staying in Nigeria, is not even in Nigeria, but you intend to stay there permanently, indefinitely, we can say that the person is domiciled in Nigeria. And how do you know that? Is economic and social interest. Where does his family stay? How frequently does he visit the place? Does he have a house there? Does he maintain bank accounts? Does he have social affinity? Let's say he's a member of a social club in Nigeria, even though he's staying in Canada. He has 2 houses, one in Lagos, another one in the village. Issues around that. It must show an intention to stay in that particular place indefinitely, and it is factual. There must be activity or circumstances that is suggestive of that. And this issue of domicile, and we can take a sneak peek from the UK, and in determining domicile, it also bears the same explanation I have given, but I would like to just use a case of a man who, a decided case of Gaines Coopers. So Gaines Cooper was resident in the UK, and for one reason or the other, he felt that he was tired of staying in the UK, presumably because of taxes, and he relocated to Seychelles. And the taxman said, even though he was not physically resident in Seychelles, he was still deemed to be tax resident in the UK, and they sought to collect the tax on his income. And he explained that, see, there were guidelines on this issue of domicile. I've ticked the box on these rules. I didn't spend up to 120 days. You can see I have a permanent place in the Seychelles. I have business interests in Seychelles. You can see I don't think I even spent up to 120 days in the UK. So how are you tying me back to the UK and imposing tax on my income? And the case went all the way to the Supreme Court. And the reason the HRMC won the case the reasons were very simple. Not very simple, are clear. They said that even though he was not physically resident in the UK, his economic connectivity was still present in the UK. E.g., his wife and his children or child were still residents in the UK. He had a couple of exotic cars in the UK. He was a member of a social club in the UK. He visited and attended high-profile events in the UK. So even though he had relocated and was resident in Seychelles, he didn't give a clean break from the UK, and he lost the case. So in the coming days, we expect that the tax authority will give the Nigerian version of what they deem domicile to be, so that we'll be able to speak in clear terms on what it constitutes domicile. But it's clear to know that it is one of the criteria to be deemed resident here in Nigeria. Having a permanent place available for your use, I think that's clear. Where you stay, where you sleep, where you go, where people know you as residents. I think that's it. Then serving as a diplomat or diplomatic agent of Nigeria, diplomats, ambassadors, diplomatic community that work for embassies, etc. in foreign lands. They are residents of Nigeria and they'll be liable to pay tax in Nigeria. So you can move on to the next slide. We'll now go a bit deeper into how to ascertain the total income of an individual. So what is the total income? It's simply your taxable income less your non-taxable income. We've spoken to some of this: your employment income, your assessable profit from your trade or business, you invested in this or that, the income you earned, profit from other sources, which is very broad, and you dispose chargeable assets, that is A. Then you deduct your loss, for example, virtual assets. You disposed of your virtual assets and there was a loss. You can relieve it only on the same asset. You cannot relieve loss from disposal of virtual assets from your business profit. No, it has to be assets, the hedge against income hedge against income hedge. Then your capital allowance, you have assets that you have used or deployed in generating the income. The law gives you a rate which you can deduct and compute and deduct your capital allowance, but it's only for business activities, not your personal assets. Then exempt income, we have dividend from collective investment scheme, persons earning minimum wage are totally exempt from paying tax. I think that needs to be emphasized. Fact investment income, such as your dividend, you can deduct that. And then please, the next slide. And whatever you derive, you can also deduct other deductions. No, is that the next slide? Can you go take me to the next one? Can you go to slide 22? Yeah, this should be before it. Then you have your eligible deductions. So you deduct your contributions to the National Housing Fund, the National Health Insurance Scheme, pension, interest on loans for owner-occupied property, annuity or life insurance premium, you deduct that. Then whatever you have is what you now charge to tax accordingly. Can you take me to the previous one now so that we now... Okay, let's quickly talk about employment income. So you're in employment, any gain, income and profit from that employment, no matter how it's called, whether it's bonus, leave allowance, cost of living adjustment, lunch subsidy, however name it's called, as long as derived from that employment, you are resident in Nigeria. We have explained residency earlier, and the duties of that employment are wholly or partly performed in Nigeria, and the gains or the remuneration that is coming to the employment is not liable to tax anywhere else. It is liable to tax in Nigeria. We had on number 3 below, we had earlier spoken to that, where we said that diplomatic agents that employees of government that are working and their incomes are not exempt from tax, their income will be liable to tax also. And even income that remuneration earned during periods of short absence in Nigeria, you went for a short leave and income, in that period were away from Nigeria, so money dropped into your account. All of that is liable to tax, as long as you can say that it is a consequence of that employment. And the question to ask is that if I were not employed in this office, will I get that income? If the answer is a no, then it should be liable to tax. You can go on to the next slide. So that will be the, yeah. So we are looking at the rates. There's a comparison of the old rate versus the new rate. You can see the old rate is between 7 to 24 and the new rate between 0 to 25. And this was what I was saying earlier, that if you have chargeable gains, it will now be liable to tax based on the band you fall. So if you are earning, let's do a quick internal check. So if you are earning 3 million, your tax band will be around 15%. If you are earning 12 million, your tax band is on 18%. Once your income crosses up to 25 million, I'm talking on an annual basis now, you start looking at 21. If you are within 25 to 50, you are on 23. And if you are from 50 to, that's about 100 and above, then you are looking at 25%. So that is the way it works. You can take me to the next slide. Then we've done a simulation of the likely impact of this. So please, if you look at the heading where the numbers are, you see that it's called annual chargeable income. So we are assuming that all of the deductions have been made or were not even made. So under the current regime, for a 4 million, you'll be paying 518,000 in taxes in a year. But under the new regime, there's going to be a reduction to 420,000. So if you are earning from around 21 million naira, they start increasing. So if you're earning 25, you notice that you pay more taxes in the new regime. 40 million, you pay more by about 9%. The next slide, please. Then from 70 million, which is the last number 9, you can see that the increase in tax due increases to about 17%. Like I earlier mentioned, pension contributions and any other relief were not considered at all. So we can see that for low-income earners are likely to see a reduction in tax payable, while for higher or progression, as your income progresses, it's going to have an impact on the tax payable, reflecting the principle of progressive system of taxation. So let's go on quickly to companies. I won't really speak too much to this, but we'll just go quite quickly because I understand my time is up. So taxation of Nigerian companies. What is a Nigerian company? Because that is very germane and a lot has changed under this new regime. So a Nigerian company currently is simply a company that is formed or incorporated under any law in Nigeria, meaning that I go to CAC, I get my RC number, I'm a Nigerian company. It is pretty straightforward. But under the new regime, the definition of a Nigerian company is expanded to mean it retains the former one, formed, registered, or incorporated under any law. It used to be it is calmer current, the Company and Island Matters Act. We don't know what it can be in the next couple of years. Just like it used to be CIT, now we are saying NTA. So it is broadly couched under any law in Nigeria. Then two interesting conditions or provisions were introduced, where the central place of management and control is in Nigeria and where effective place of management and control is Nigeria. These two were not clearly defined in the law. But as mentioned, we expect the tax authorities to give us more guidelines, clarification on what this really means and how it will be seen to apply in practice. But we can see that these provisions are like place of effective management. Is the place, using the OECD as a guidance, is the place where the key management and commercial decisions of the company are made. And central management and control rule is something that is also applicable in the UK. So it just bears the point that to determine whether a company is a Nigerian company or not, you have to ask yourself, or to decipher, because it's not clear, we can draw this analogy that where are the key decisions of the company, management level decision, operational strategic decisions of the company, where are they made? Where are the, such as, for example, board meetings, where are they made? Where do the directors of the company, which are the directing minds and will of the company, where do they reside? Where do they hold their meetings? So there's the risk that a company that is not resident, right, but is centrally managed or controlled here in Nigeria will be deemed a Nigerian company and then will be liable to tax in Nigeria. And there's a particular UK case that is very interesting, which is the case of the BS Consolidated Mines and OE, which was a case of a South African company that is direct operational decisions, management level decisions were made in the UK, and the UK tax authority decided to tax its profits. And even though they thought, oh, we are not registered in the UK, how come you want to tax us? And the reason they lost the case was because the directors were making and directing the activities, operational, sales, strategic, etc., from the UK. And that decision was what was codified in the tax law in the UK. So in the coming days, we expect more clarity, but we can draw analogies from this to know that Nigeria, what a Nigerian company is no longer what it used to be. We move on to the next slide, where we look at notable changes as it impacts company or businesses generally, some of which I've already spoken to. So I've spoken to the deductibility of business expenses, the classification of companies, then the new threshold. So I think I've spoken to almost all of this, but I'll look at capital allowance and compliance. So in order to make deductions for business expenses or for even capital allowance purposes, the assets, because capital allowance is tied to the asset used in generating the profits of the company, must have, at the point of acquiring the assets, all the applicable import duties or VAT due must have been paid. And what does that mean? You buy an asset, say a car, and unfortunately a business buys a car. Unfortunately, the custom papers do not come with it. Sad. And the taxman may be doing its review request, because it's one of the routine requests they make during tax audit reviews and exercises or investigation exercise, even sometimes tax review, but not necessarily. And they request for the documents too, because you are making a deduction, reducing the potential tax pay, because it's a reduction in the profits of the business or the taxable profits of the business. And upon provision of the document, whether the VAT that should have been paid on the car was not paid, the import duty was not paid, because for one reason or the other, it was deemed to be cost effective, capital allowance that may have been claimed will be lost. And not only lost, because that adjustment will result in additional tax liabilities. The additional tax liabilities will bear interest and penalties. From the day the taxes ought to have been filed. So that carries a huge risk, and businesses, while we understand that input VAT is not claimable on assets, rather than what do you say now, capitalizing it, you can expense it. It is a big risk to ensure. So it is a caution to ensure that all applicable import duties or value-added tax on assets should be paid. And I will also add, it is possible to receive an invoice for which the seller did not charge VAT, and it makes sense not to pay VAT because the person did not charge. But you won't be able to claim deductibility of the capital allowance or the business expense if VAT is not paid. So these are cautionary measures that needs to be implemented in running businesses going forward. So I will leave the other one of the national allowance. There's a new guideline around claiming of capital allowance. Initial allowance, balancing charge, balancing allowance is no longer operational. Let me quickly run because I'm out of time. The next slide, please. Okay, digital innovation, very key. So the FIRS is in a, can I say, digitalization drive, meaning that they are moving from, they are more digital, IT savvy and digital driven. And one thing, apart from, since 2021, tax returns and a number of operations have been digitalized. TCC is digitalized. Withholding tax credit is automated, digitalized. You don't have to carry paper reconciliation. Once the payer, or the payer for the service or the goods are deducted, it can remit to the taxman. The withholding tax credit automatically sits in the beneficiary account. So you don't file paper documents with FIRS more often than not. You don't. It happens, but the FIRS is going digital. And to take that to a higher level, they've launched the matcha buyer system, which is in phases. And currently, from October 1, November 1, I beg your pardon, it's expected that businesses with turnover of above 5 billion ought to have been onboarded on that platform, meaning that in issuing invoices, it is the what they call matcha buyer invoices, where between the seller and the buyer, the invoice is uploaded in a digital format conforming to certain formats and digital criteria, and it is run through the FIRS system, and the FIRS has visibility on how much you are earning without necessarily having to visit your books. This is being implemented in phases, and we expect, because the wordings of the law is not limiting it to just businesses above 5 billion. It is taxpayers, properly so-called, broad enough to include practically everybody. So meaning that the FIRS has visibility in whatever you are doing and does not need to visit your office to know what is happening in number terms. So if you are not reporting, the other person will report. And if you are not reporting as well, there are penalties that comes with it. The next point is on disclosure of financial information. So banks, insurance companies, stockbroking firms, or other financial institutions are required to file returns to the tax authority. It was there for banks, but it's now expanded. So for commercial financial transaction, you can see banks, where does money go to? You take insurance policies, you dispose your investment holdings, or other financial institutions widely couched. So they are going to make returns to the tax authority, disclosing transactions on a monthly basis. So if it reaches the 25 million threshold for individuals and 100 million for companies, then FIRS will see it. Then tax IDs are also now required to access services provided by these financial institutions. Then there's a lot of provision in the law to ensure that to ensure collaboration between state and federal authorities. So where a state authority does not have resources, can pitch its tent with the NRS to support it in recovering taxes from taxpayers. So they can leverage technology resources from better or stronger tax authorities to ensure that tax revenue is not lost. Then this has always been very worth repeating, that FIRS has collaboration with foreign jurisdictions, and there's what we call common reporting standards, where financial institutions report on transactions in foreign jurisdictions. So, and it is shared across jurisdictions, and of course they can seek assistance where the need arises. The next slide, please, so that we can quickly conclude. So I decided to include this penalty regime. But before I go to the penalty regime, so for a business or a taxpayer, so having heard all of this, what should happen? The first thing is that you should ensure you have your tax ID, you monitor your incomes, your disposals, you keep track of your financial transactions, you file your tax returns as when due, you document appropriately, and not you only document, you archive your document, because every claim being made must be substantiated with relevant corresponding document that speaks to itself. So once the taxman receives the document, it goes without saying that you're entitled to that deduction, to that relief, or whatsoever. And whatever has been done, filing of returns must be done as at when due. These returns carry interest and penalties automatically. The taxman is digitalizing its activities. So on the portal, the filing portal, especially for FRS or NRS, once you are late, it's automatically calculate. So there's no hard saying you just have to go and pay the penalty. Unfortunately, particularly for interest, it accrues on a daily basis. So it won't be the best to miss filing deadlines. So let's look at the penalty regime. Failure to register for tax, 50,000 naira in the first month, 25,000 subsequent months. Failure to deduct payee or withholding tax. Yeah, I did mention withholding tax. Pardon me. Withholding tax is not a separate tax set. Probably that's why I didn't speak to it, but it is an advance payment of income tax. So it is to ensure that as taxpayers are being paid for the service they provide or the goods that they are selling, the customer or the beneficiary of the service, at the point of payment for that service, deduct withholding tax and remit it to the tax authority, meaning that at the end of the year, say your tax liability is 50,000 naira and there'll be withholding tax deductions of 50,000 naira. You don't need to pay additional tax. You just use your withholding tax credit that your customers have been remitting in the course of the year to the taxman. You just use it to offset. So at the end of the day, no cash will flow. But if you don't have withholding tax, then your cash will flow. So for a person that is supposed to deduct withholding tax and fail to, meaning the beneficiary of the service or an employer of labor that refuses or fails to or forgot to deduct payee, administrative penalty of 40% of the amount not deducted. I will concentrate on the new regime. Failure to remit. Now you deducted, but you not pay. You quickly used it for business, cash flow issues. There's the unremitted sum, interest, penalty. Please, the next slide. Then the taxman reviews your books and asks for you to provide information. Of course, they'll be specific on what they want. And you fail to, administrative penalty of 20% and 200,000, pardon me, and 10,000 naira for each day, meaning that the taxman does not want to waste time. Once he writes asking for information, you provide as at when due, and no time to be wasted and no time to delay the conclusion of their review. Their failure to file returns, I think I've spoken to that. There's penalty. Imagine not filing VAT for 2 months. Fail to file VAT in November, no, October, and okay, November's return was not yet. Let's say August and September. In the first month, you fail to file by 21st of August of September, that's 100,000. By October, that's another 50,000 for the first month. The second month, you fail to file again, add another 100,000, that's 250,000. And you may not even need to pay any VAT. Just maybe you're filing new VAT returns. For failing to file a new VAT return, meaning that you didn't make any income that month, you still are liable to pay a penalty of 250,000 naira. So filing a tax returns is a big deal. Failure to notify the relevant tax authority on the change of address, 100K for the first 100,000 naira for the first month and 50,000 for each subsequent month. The failure continues. The last slide, please. Is that all? Okay, general penalty. Where no specific penalty is provided for an offense, administrative penalty of 1 million naira or term of imprisonment not exceeding 3 years. So the punitive regime under the new, the penalty regime under the new tax regime is more stringent, and it goes without saying that one cannot be lax in doing the needful. Please, the last slide, I believe. Okay, so what should we do? We need to understand, which I believe that at least we have some level of understanding of what the impacts of these reforms are. Of course, like I mentioned earlier, it's much more expansive than this, but this is just like a teaser of what it is. You have to register and obtain tax ID for those that have not done that. Then management of financial records, very key. Ensure timely reporting and filing of tax returns, and where you need assistance, always engage tax professionals to review and manage your tax affairs. It's better to be properly guided than having to say sorry. There have been instances that people either fail to approach us for assistance too late in the day when they've gone far and made errors. So it will save everybody at the end of the day. Thank you very much for taking our time to listen. I'm open to taking questions and answers. And so I'm open to responding to your questions. I beg your pardon.
All right, thank you very much, Mrs. Olusegun. Thank you for the presentation. It was quite insightful, and I myself learned a lot from that. We have a few questions. In case you don't know, 144k has an investor community on WhatsApp, and some of them have their questions there. They send their questions there. So people have reached out to me. So we have a few questions. I think I'll just read them out. So the very first question I'm going to ask is with regards to dividends. I know in the presentation you mentioned that where you get dividends for collective investment schemes, they will be chargeable under personal income tax, right? And someone asked that if they reinvest their dividends from collective investment schemes automatically in a way that it doesn't accrue to them or doesn't go to their account, will they still be taxable under the PITA? You know, sometimes some collective schemes have apps that help you invest your interest or the dividends you get from collective investment scheme, and it doesn't go to your account. You don't derive any benefit from from dividends. Would that still be chargeable, or would it be taxable? That's the question.
Thank you. So I had mentioned that returns from collective investment scheme under the new regime is not liable to tax, is exempt. So it won't be taxable.
All right. Thank you very much. So if you ask that question, it will be taxed because, of course, it didn't accrue to you at all. All right. Thank you very much. We also have another question. I think you've answered this, but probably to reiterate it again, the question is typically interest from investments such as bonds and commercial papers are subject to withholding tax, which is deducted at source. Will I still be liable to pay personal income tax after the withholding tax has been deducted at source?
So the general rule is that if the income is not deemed exempt and is not deemed final tax, and what does final tax mean? It means that the withholding tax that has been deducted is final. So let me make it more granular. You know, for companies, or since you're acting as an individual, so let's assume that the withholding tax rate for interest is 10%, and the person is liable to the effective tax for that person is, say, a 15%. So the difference between the withholding tax that be deducted at source is like 5%. That is 15 minus 10. So in filing or making the tax returns to the tax authority, you will still need to disclose the gross amount, right? And offset the difference meaning that you've paid suffered tax at source of the 10%, you add back the gross amount to your other income, and if it's the only one you have, you form your income, you offset the tax credit you have gained from that deduction at source from the tax payable. Then the difference is all that you remit. I hope that's clear. So if it's not final tax, you still be liable to pay tax on it, but you gain credit for the tax that you have originally suffered at the time the payment was made to you.
All right. Thank you. So essentially, when the tax is deducted at source, you can use that to offset your final tax liability. Right. Thank you very much. So there's also one question here. This one seems a bit philosophical. So this question is from a small business owner, right? This is asking, what is the incentive for me as a SME business owner to pay tax when I can just keep all the profits to myself? There's nothing I stand to gain. Why should I be paying tax?
Okay. Yeah, I see where what you're saying. So I'll say it from two perspectives, but let me start from the first one. So it's from our initial quote, the gravity is always avoidance, and particularly for in this climate where we are, where you tend to bear the burden of government, you tend to maybe bear the burden of boring, getting water, paying for energy, inverters, and everything that comes with it. Even the public school, people know, but the education is very expensive. So in a way, you can say you're not feeling the impact of government, whether at the central, at the top, or at the state level. So it is a disincentive to paying tax. But the question I like to ask in instances like this is that, will that reason be enough should the taxman write you? Will you be able to respond to the taxman formally to say that the reason I didn't pay my tax was because I don't feel the impact of government? It won't be a basis to respond to a formal demand from the taxman. Now, that is on one side. For an SME, don't forget that there are incentives already granted, and mentioned that there are two sides now. I'm assuming, right, that the income, as long as the profits, if you look at the tax rates that are projected earlier, I said that 0% is for 800. The first bank, if you could go back there, the first bank, you see 0 to 800,000 naira is taxed at 0%, meaning that if the income for that, if the income is less than 800,000, the taxman will not even tax it. And even if it's 3 million, that is adding the 800 to the 2.2 million, the first 800 will still not be liable to tax. So it will be just the 200,000 chargeable income that will be liable to tax. So that's a form of incentive already. Now, another layer to it is that some of the changes that have been introduced, particularly for VAT, you can see that you can expense a lot of VAT payments, right? And you can plan your financial affairs so that you can minimize. Tax planning is not an illegality. It is when you're evading tax that it becomes illegal. You can plan and manage your financial affairs to pay the minimum level of tax legally applicable. You don't need to expose yourself to tax unduly. You can manage your financial affairs in the legal way to reduce the burden of tax. Then, particularly, there are some transactions that for you to undertake, maybe you are bidding for jobs, and nobody wants to be small forever. You want the business to grow. There are transactions you want to do. And I'll give a very good example. You need a TCC to apply for a building permit. And at that point, to be able to have landed property where you need regulatory approval, one of the documents you need to provide is evidence of paying taxes for at least 3 years. So that document does, even if you provide one, it will be compared to the value of the property you are trying to acquire. And if there are issues, say you are providing a TCC where you are saying you've earned income of 2 million and you're trying to acquire a property, or maybe cumulative income is like 5 million, you're trying to acquire a property of 20 million. The taxman will start asking you questions and you have to explain. So there are issues around evading or not paying taxes. But when the tire hits the road, that excuse will not suffice. I think that's my response.
Thank you very much. So, if you're planning not to pay your tax, ensure you have good reason, not that you are not feeling the benefits. Please pay your tax. Don't plan not to pay your tax. Thank you very much. And the last question, hopefully, let me check if there's anyone. Okay. Okay. So, there's a question in the chat box, and the question is: when I check my contract notes after selling a stock, I don't see capital gains tax there. Does it mean I am exempt? You're muted.
Sorry. So I we will need to look at the fine details to know, because at times there are transactions that are exempt for. Did you say capital gains tax?
Yes. So the person is asking that when,
because my mind is going to stamp duties.
Yeah. Okay. So the
Okay,
question
let's
here
talk
is
about
the
capital
contract
gains tax. So for the capital, since that's the question, let me attend to the question just the way he has asked. So for capital gains tax, it is the person that has made the disposal that has to disclose the transaction and remit. So I don't know, the burden is on you to make excuse me, to make the disclosure in your tax returns compute the applicable tax due, which is the difference between the cost of acquisition of the stock or whatever you are disposing and the sales proceeds, the difference, then allowing certain expenses. Then you arrive at your chargeable gains, apply your 10%, and you disclose and remit to the taxman. So the taxman will not come to you because really they may not have known you have disposed. I won't say they don't know. They may not have known you have disposed. So the burden of remitting the tax is on you. You have that obligation to disclose and pay. And should you now review, because I don't know the full details of the transaction and you're exempt, then you can now take the exemption. That's all.
Thank you very much. So the fact that it wasn't there doesn't mean you're exempted. You have the responsibility to ensure you remit your tax. All right. Last question. I know you mentioned that some businesses are exempt from paying company income tax. And this has made the rounds in the news, a lot of publications on how to take benefits of that. So say I'm a small business owner and I just have a business name. Can I take advantage of the exemption from company income tax if I do not meet the threshold for that tax to be taxable on the income of my business?
Okay, so the exemption can typically come from two broad categories. Exemption can come as a result of the turnover, which was what we're speaking to, and the nature of activity of a company. So, Bob, since you're saying that it's a small company, right? If the company meets the threshold, and I mentioned that the threshold for small companies is 50 million naira, and they don't have capital assets of more than 250 million, and they are not providing professional services, right? They will be automatically entitled to the tax exemption on their profits. That comes as long as the conditions are met, it is automatic.
Okay, so there's no need for me to say register as a limited company. I can stay as a
I think
business
I
name.
get the question better, right? So the question is that the business is currently operating as an unincorporated entity and wants to take advantage of the exemption granted to companies under the NTA. I believe that's the question. That should that be the next line of action? Well, it's a business decision, if you ask me, and then it has to be carefully considered. And one thing that I need to emphasize that it comes with its own implications. One, don't forget that you still have to file tax returns. Right? It doesn't exempt you from certain tax obligations. Now, even if you are filing, you are enjoying it. The other thing is that the tax authority has more visibility on your affairs. And no business wants to remain small forever. So if the turnover is less than 50 million, the expectation is that the business will grow over time, unless you want to play small in the long term. So it's something that they may want to consider, but it has to be properly thought out.
All right. Thank you very much, man. Just one more question and we'll wrap up the Q&A session. So this person is asking, is the tax ID from the LIRS a different tax ID, or is there a universal tax ID for the whole federation that they should consider getting?
Okay. Yeah, that's an interesting question and it's very valid. So right now, each state tax authority have their different tax IDs. And there's also one that is jointly administered by what we call the Joint Tax Board, which is like the, can I say the existing agency that will take over, that the Joint Revenue Board will take over from, just like NRS taking over from FIRS. So there's a centralized tax ID that is managed by the Joint Tax Board, irrespective of where you are located. You can get the JTB team, and there's a portal where that can be done. And in some states, I think Edo states, to facilitate getting the TCC, you must have a JTB team. I think FCTIRS also does that. But more than that, each state still has their own tax ID. Lagos State has their own tax ID, and you can onboard on the e-tax filing portal to obtain your tax ID. Ogun State and a number of states do have. So now for the new regime, a lot has been said, and I recently saw a video by the FIRS saying that they won't issue a new tax ID, but rather is the RC number of companies that they will use in migrating, but that needs to be seen. And for individuals, their NIN will be used as their tax ID. That was only a video. It's not an official communication. So currently, each state has its own tax ID, and there's a JTB thing that is centrally administered by the JTB, irrespective of your state of residence. You can get it and you can access it online. So that's what the case is. But should you really want maybe to process some tax-related applications, say your TCC with the state tax authority, I can tell you for sure, like Lagos State, you need their tax ID, and a couple of other states too.
All right, thank you very much. I must say a very big thank you to you for your time and for the vast amount of knowledge you provided to us this afternoon. And I'm sure that, like me, a lot of people have learned a lot, and with the foundational knowledge we have, we can explore the new tax laws with a fresh mindset. So just to conclude, I would mention once again that 144k is an investment community that is dedicated to ensuring that you grow your income on the long term through investment opportunities that we try to bring to our members, right? We conduct investment education, and we also try as much as possible to help our members grow. So we have an investment community, as I mentioned, a community that's on WhatsApp, and we're sharing the link now in case you want to join the community. Routinely on the community, we share information with regards to investment opportunities. We conduct investment education, and we hold discussions, general discussions on macroeconomic conditions and everything you need to know as an investor to make informed investment decisions. We also routinely conduct webinars such as this, right, that are relevant to ensuring you make informed investment decisions. Once again, I would like to say a big thank you to our facilitator. If you have other questions, you can ask us in the community. We'll reach out to our facilitator, or if you require legal advice, financial tax planning, as you mentioned, to see how you can minimize your tax exposure, you can also reach out to our facilitator. She's an expert with that. So thank you very much for attending today's webinar. As the facilitator mentioned, this is a foundational class. There will be more to go into the nitty-gritty, because it is broader than this, to go into the nitty-gritty of the Nigerian tax system and how it applies to you. So once again, thank you for attending the session. Thank you to our facilitator, and we look forward to seeing you in the community and also seeing you in subsequent webinars. All right.
Thank you very much. It was a pleasure being here. Bye.
Right. Goodbye, everyone.